The Federal Reserve recently released the minutes from the latest Federal Open Market Committee meeting on May 3rd. The minutes indicated that the Fed had raised the target range for the federal funds rate by 25 basis points to a range of 5 to 5.25. This marked the 10th consecutive rate hike since March. Unfortunately, the banking crisis in the United States has only escalated since March. Some experts believe that continued aggressive rate hikes could exacerbate the crisis, bringing the U.S. closer to a recession. As a result of the Fed's rapid and sustained rate hikes, banks are experiencing significant asset losses, leading to the closure of small and medium-sized banks. Biden's assurance that banks are safe is misleading, as depositors frightened by bank closures will likely withdraw their money from small banks and move it to larger banks, making the U.S. banking system even more fragile and possibly causing another wave of bank failures. According to the New York Times, the Fed is using euphemisms such as soft landing or hard landing to avoid the issue of an economic recession. In reality, there is a high probability that the U.S. economy will slow down within a year, and the soft landing that the Fed expects may be difficult to achieve. Yellen has issued a stern warning that the U.S. may default on its debt as early as June 1st, facing the risk of defaulting on all of its obligations, leading to a historic debt default and liquidity crisis. On May 2nd, Fox News reported that House Speaker Kevin McCarthy had accepted President Biden's invitation to discuss solutions to the debt ceiling issue on May 9th. However, current reports suggest that there is little chance of a compromise between the two sides. The risk of a U.S. debt default has already been reflected in the U.S. Treasury market, where yields on U.S. bonds maturing in June have risen above 5 and are being aggressively sold by the market. Meanwhile, the price of gold, a traditional safe haven asset, has risen to near all-time highs. This suggests that going forward, as the Fed gives more dovish signals or even hints at further rate cuts, and as the latest evidence of a U.S. economic downturn, banking crisis, and debt default emerges, gold will continue to be boosted as a competitor to the U.S. dollar, demonstrating its strength. This will make it increasingly clear that the de-dollarization efforts of the world's central banks are turning the tide against the dominance of the U.S. dollar. On May 3rd, investor Stanley Druckenmiller warned that the U.S. debt crisis is like a horror movie, and that the current debt ceiling debate in Congress is nothing compared to it. The U.S. debt crisis is even more severe than imagined, and the actual burden may approach $200 trillion. The U.S. debt-based economy has long been unsustainable, and a severe economic recession in the U.S. is inevitable due to the increasingly complex economic situation and default risks. Unless the U.S. stops borrowing so much, the U.S. debt-based economy will eventually pay the price, and the timing of that price is in the hands of the world's central banks, the largest buyers of U.S. bonds worldwide. A report by the World Gold Council on May 2nd showed that since the U.S. subprime crisis, global central banks have been forced to continue buying U.S. government bonds, but the actual yield on many bonds is very low, even negative. The U.S. is facing a serious default risk, which casts a huge shadow over the safety and stability of U.S. bonds. The world's central banks, including China, are accelerating the liquidation of U.S. bonds and replacing them with gold as an international reserve asset. This shift towards gold as a reserve asset could have significant implications for the future of the global economy. It may signal a loss of confidence in the U.S. dollar and could lead to further diversification of reserve assets away from the U.S. dollar. As countries continue to accumulate gold reserves, it could also lead to increased demand for the precious metal, potentially driving up prices. Texas has recently announced that it will draft legislation to make gold a legal currency and allow it to be used as a universal currency for debt repayment, while creating a gold-backed digital currency as an alternative to the U.S. dollar. This move comes amid concerns over the Federal Reserve's lack of transparency on debt issues, which is weakening the confidence of U.S. bond investors. The hidden default risk of U.S. debt has also increased, and expectations of a Fed rate hike and debt default have sent interest rates soaring. As a result, it is expected that global central banks will continue to sell heavily in the coming months, possibly liquidating $800 billion of U.S. debt or reducing their U.S. bond holdings to zero in order to reduce their risk of U.S. exposure. The White House did not anticipate that the date of a potential default would come so soon, and an accelerated timeline could disrupt the U.S. government's response to potential crises. If the debt default situation spreads, The U.S. can use gold to prioritize the repayment of debt and interest to major buyers of U.S. bonds in order to recover from the damage to its reputation, as the U.S. Constitution stipulates that all bondholders shall be repaid. However, the U.S. cannot renege on its obligation to repay its debts, nor does it have the right to default. Some congressional leaders have suggested prioritizing payments to China and Wall Street institutions or minting $1 trillion worth of platinum coins to repay the debt to ensure that the U.S. maintains its ability to pay. Treasury Secretary Yellen has warned that a U.S. debt default would cause a credit collapse, adversely affect the U.S. credit rating, seriously damage the global leadership of the U.S. economy, and call into question the ability of the U.S. to defend its national interests. A U.S. debt default could trigger a collapse of the U.S. dollar and seriously undermine the economic strength and financial prestige of the U.S., leading to catastrophic consequences. According to a report by credit rating agency Moody's, a default on U.S. debt would wipe out about $12 trillion in U.S. household wealth. As a result, Moody's has called for an immediate increase in the debt limit to ensure that future generations can enjoy the same benefits. Express your thoughts by leaving a comment in the section below. We appreciate you for sticking with us until the end of this video. Before you leave, please show your support by giving us a thumbs up and subscribing to our channel. Don't forget to hit the notification bell to stay updated with our latest videos. We look forward to seeing you again for more captivating content in the future.